going to look at some option parameters. You are all familiar with options, call option, put option, strikes, all those things you may be familiar. But there will always be doubts in your mind that how does this option work? Because many times you may be finding that the option price does not move as much as the futures does, right? So that's the basic doubt that you get normally. So if futures price has moved by 100 rupees, you see option price of various strikes moving by different rates. So why does it happen? So the first thing is, now what is the link between options and futures? What is the link between options and futures, right? Then why there is the doubt regarding the movement of option price with respect to futures versus futures rate. Then suddenly when you see sometimes price not much of a movement, but suddenly the option price either goes up or goes down significantly, right? So why is it that when the price is not moved much also, there is some chance that probably the option price could have moved in your favor if you are a buyer of an option, or sometimes you could have worked against you. So what are the other parameters that moves the option price, right? And then another thing normally which probably you may be wondering, that today is being Friday, okay? So let us say the market today closed close to 17,100, right? So 17,100. So we go to the option chain in and look at the price for May month. So it is coming closer to the call option is 361, put option is 330. Okay. So call option 17,100 for May 26 expiry is 360 and put option is 330, right? So on Monday, let us say the price today, the futures price may be 17,130 or so, right, for May. So on Monday, let us say the price is at same 17,130, okay, there is no movement, or it moves but it comes back to the same price of 17,130. There is a good chance that probably this price might have come down to 350, this could have come down to 320 or so. So you'll be wondering that why am I losing my money? In case if you are a buyer of an option, you may be wondering as to why this is happening for me, right? So you must understand that certain parameters which affect the option price, so that we are not disappointed in taking it, or let us go with something which we understand, or which we like it, or probably which will be useful to us in a way which suits our personality. That is how I will put it. But despite that, there is always a big volume now happening for option, irrespective of whether it has got advantages or disadvantages. There is a big craze for option trading, and today the option is very heavily traded, particularly in case of Nifty. Now, what makes this particular product successful? Particularly, a lot of speculators have also jumped in. Now, option basically first as a tool is considered more for an edging. That is, first option more as a tool for edging. Like futures, option is also a tool for edging. So this is how this was designed. This is how designed. So if you have a cash market share, maybe the Reliance or TCS, so you would like to hold the share, you do not like to sell the share. So in that particular case, you would like to see that if there is a downside thing that happens either for these stocks, then in that case you are protected. But at the same time, if there is an upside, then you don't want to lose the upside. Okay. So for that particular purposes, options became the tool, and that is how the options got familiar or popular. Now, international exchanges like CBOE has been there for the last more than 50 years since it started trading options. It has become almost 50 years. There is a great effort in 20 years now, and we are also having very good system as far as the options risk management system is concerned. But here the most of the traders who have now jumped into options right now are purely speculating using options for the direction of the market. Okay, there's nothing wrong in that, but as long as you understand this. The reason that I'm telling you is this. Now, let us say today we saw the option price is 330 rupees. 330 rupees. Now, the one thing that if you see the last 5-6 months, the price option, the futures price on expiry date is the same. எங்கேன்னு ஆரம்பிக்கணும்? Sorry for the disturbance, technical disturbance. So we will continue with where we left. If you see last couple of months, the price, say, let's go the chart, monthly chart. No, in the monthly chart, we will not be able to get exactly the Thursdays of every thing, but approximately you'll see. See, the last few months, we see this is the close. Okay, so this is something like this is the last day of the close. So 16,983 on the last day, 17,354. Okay, 17,339. So 16,800. Okay, only this month we had 17,464 and 17,100. But in futures, when we saw in the last, so even if you take this particular price, now, so if in futures, what we have seen the last 6 months approximately, the price is almost on expiry date is closer to 17,100 on an average, plus or minus 100 points, 200 points. Okay. Assuming that it is slightly more also, what is the option price that we said today? 350 rupees. So the price should have been either, if you are a buyer of a put, 17,100 minus 350, or if you are a option buyer of call option, it should have been 17,450 or so. Okay. So to the close price of the expiry month, we have not seen close to. Okay. இன்னும் ஒரு தடவை பார்க்கலாமா? ஃப்ரீஸ் ஆகிட்டு திரும்பி ஆரம்பிச்சிருதா? ஓகே, பண்ணிட்டோமா? So the price of call option and put option should have been either 17,100 plus 350 or 17,100 minus 350. So on the expiry day, if you see it closes flat, that means in all the 6 months, if you had bought a call option or you bought a put option, you would have lost. So what does it show? Probably the option sellers are making money and option buyers are not making money. But the same thing can't be said for every month, because we have seen sometimes a big fall or big rise also happening in the last couple of the preceding. Before that, we have seen good amount of rally also. But generally speaking, we have to be very quite adept in options, because if we don't either take profits properly, or if we take too much of time in assessing the situation, chances that we will lose everything. So first of all, that we should know that the most important factor that is working against this is the time decay, which is linked to the volatility. It rose by another 400 points, 1,100, from there another 300. means what has happened is the full time decay. So we are paid for the entire month and got nothing. So the volatility is 0. So that means the entire premium is decayed totally, right? So it has resulted in a loss. So this is the biggest tension for any option buyer. That is, whether to what extent it will move. What should we do about all these things? So in the case of an option buyer, the general thing is that if you are very static, chances that you will have definitely potential chances of a loss. But if you roll over the options, you will keep paying the rollover cost also. So you will keep paying the rollover cost also for doing that option. So we need to understand that the option, how we should use these options, how we should use this option in the and what type of structures we should consider for the option then in that case, so that we don't lose money. Okay. So we have also talked about various types of structures before. So what is a structure that probably could be helpful for us is what we should look at it. That is, basically we should while going for an option, for particularly if it is for investment, what is the goal? So the option generally thing is, first of all, we should understand the parameters and what is the goal for doing it. What is the goal? Okay. Now the goal is, let us say I want to reduce investment amount. I want to reduce investment amount. Okay. If that be the case, then going for an option and doing a proper rollover of the option, okay, to reflect the quantity of shares that you want to hold or the type of futures that you want to hold has to be done. Then in that particular case, there is a good chance that you will have a very, very reduced investment, and the return could be more or less appropriate to the extent of the funding that you have taken. Okay. So that is the most important thing that probably we should have. So that is where we had a session last time about the option rollover. Okay. And the option rollover to replicate a cash buying in a case of a stock or in the case of an index. So for which we need to understand the parameters, and one parameter we have told you is delta. Okay. Another parameter is the IV, volatility. Then another parameter is the thing is the worst type of, because in the case of volatility probably the effect could be a little could be slightly marginal. Sometimes it could be marginal, may not be much, because 15-20% of the option price could be the change. But if the time decay is where the maximum amount of decay that will keep taking place if there is no price movement. If there is no price movement, means there is no volatility. So in a very large way, this IV can be linked very clearly with the time decay. Okay. Delta is nothing but generally speaking, it's a probability of something. Now when you toss a coin, head or tails coming, it's 50-50, right? So if you do 10 times, 5 times chances of head, 5 times tail. So in a large number of tossing of coins, it will be 50-50. So based on that, the delta is always considered to be, for at the money, is always considered to be 0.5. Okay. So this is not a very major issue at all for us, and this can be to a very large extent it is just an understanding of what delta means, and in order to ensure that the quantity of shares that we buy is what we want. In the case of an option, the delta, what we do will be on the multiple of contracts that we hold in the option, to what extent it should replicate our cash holdings. So to that extent, the delta is important. Now, but for understanding purposes, the first thing that you may think about it is, now let us say tomorrow the futures from 17,100 moves to 17,200. And you are holding a 17,100 call option. So when this 100 rupees movement takes place, okay, now let us say today you bought an option for 360 rupees, 17,100. So what is now, the 17,100 is considered to be hadda money, because it is futures price is also at the same price, approximately is at the same level. If that be the case, tomorrow if it moves to 17,200, this 17,100 at the money, because that is the price where the price is, futures price is. So delta will be 0.5. Say where the futures is the closest strike will be very closer to the 0.5 delta. Now this delta will be different for different strikes. In the money will have greater than 0.5. Out of the money call option will have lesser delta. Now let us say tomorrow it moves only to 17,000 to 17,200. If it's a delta, okay, then what should ideally happen? What should ideally happen is this price, 100 rupees price movement into 0.5, right? So 50 rupees, the option should move from 360 plus 50, it should move to 410. So the option price, the delta tells you that to what extent the option price will move for a corresponding movement in the futures price. So if there is a 50 rupees price movement, then in that case you will get 360 minus 50, 360 plus 50, you will get 410, right? That's the most theoretical ideal case that you will be looking for. But that's not going to happen. That's not going to happen. Why? Whether it's going to be 50 or it is going to be less than 50 is what we have to see. So what happens in that particular case, if this for this 50 rupees to happen, okay, or corresponding movement that has to happen, the movement in the option and the movement in the futures price should be equal to what the volatility represents. Only in that case you will have this particular movement. See, yesterday let us say the close price was 17,220 or so, right? 17,220. Yesterday's price was 17,220. Let us say close price is 17,230 or okay, 230 or whatever it is. Now today the close price is 17,110. 17,110, right? So what should have happened in the case of a put option? If you have bought a 17,200 put option, ideally whatever it is, 50 rupees, it should have gone down. Okay, it should have appreciated, right? For this. So let us see what happened compared to yesterday. So the price 17,200 has moved by 47 rupees. That is, there is an appreciation in the price to the extent of 47 rupees. Right. So yesterday 17,200, sorry, 200 put, okay, the price yesterday's closing, okay, was 17,250 or so, right? So 17,000, it should have been 17,250 or so. Let me see. So yesterday's future price, we will look at the futures price. So NSE futures price, or we will look at the this one also. There is cash market itself. Yesterday's price was 17,245 and today it's 102. So 143 rupees is the price movement. 143 rupees should have been the price movement. Okay. So if you had bought a delta which is closer to that 17,240, this should have been something like 0.45 delta or so. Okay, I'll explain to you later on. So for a movement of 143 into 0.45, so this should have been the benefit that should have got in option price if you had bought a put. So 143 into 0.45. You should have got 64 rupees profit. You should have got 64. But how much you got? You got only 46. So that means 18 rupees compared to this you have lost. So why is it happen? It has happened because the volatility on close to close basis is not matching the volatility of what you have bought. What is that? Yesterday when you bought this price, okay, you might have paid for a volatility which shows that probably the price will move by 200 rupees. So nowadays the volatility is pricing for a movement which is around 230 to 240 rupees. 230 to 240 rupees. But whereas what we got is only 140 rupees. 140 rupees is what we got. So that means approximately I'm telling you 240 rupees. Why we are talking about 240? Let us say you're talking about a 20% IV. 20% IV represents 1 divided by for 1 day. It should be a 1.25% movement. So 17,200 into 1.25, approximately 220 rupees. Okay, but the ATR is all giving 240 to 230 to 240. So approximate that range. So if the price had moved by 220 rupees, so today let us say from 17,240, okay, it had moved down to 17,000. If it had moved to 17,000, then the entire 242 rupees which you got, you would have got the entire thing 242 into 0.45. So you would have got, this is appreciation, you would have got 242 into 0.45. You would have that 108 rupees. So if there has been a price movement to the extent of 240 rupees, you would have got the full benefit of the option price movement. When you don't get that, then that's a good chance that probably you will end up on the losing side. You will end up on the losing side. Losing side in the sense that to the extent that you should have got the appreciation, you might not have got it. So that one reason that whether we are going to match that particular volatility, we are not very sure. About that. Most of the times, because the option seller has an advantage, because he sells the option, so that means he takes the risk. So you will always be pricing a slightly higher volatility. That's a norm. Okay. So if it's a 20% thing, chances that at the end of this particular month, we might have seen something like a 15 or 16% volatility and not a 20% volatility. Which means there's a good chance that probably 20% of the likely option benefit that you should realize, you may not get it. So in this case also, the movement is 143, whereas let us say that it has priced around 220 rupees. So to what extent you are not got? So you 143 divided by 220. So that means the volatility that you priced to the extent of it's only 65%. So 35% the volatility has not matched your expected. That means that 35% of the option benefit that should have got, you should not have got it. So that is what it reflects. So for example, when it should have been 64 rupees. So approximately a 30% of this move will be 64 into 0.3, which is around 19 rupees. So that is what we are having there. So that means we have not got the volatility matching our expectation or what we have bought. So that means you should be getting closer to 220 to 240 points on a close to close basis, in order to ensure that or slightly more you should get, in order to ensure that the full benefit of the price movement in futures is reflected in the option price to the extent of delta that you are holding. So I hope I'm clear in saying this. That is, whenever you say the delta is 0.5, okay, that means for an appreciation of say 100 rupees, the option price should move by 50 rupees. But it will not move by 50 rupees if the volatility that you have bought, which is 20%, and it reflects something like a 220 points movement, and if it has only moved by 100 rupees, you will not get that. But if it has moved closer to 220 points, then in that case you will get match. So you should get something very closer to this in order to get your full benefit of the delta thing. So that is where first understanding has to be there. That is, to a very large extent, the volatility will play a part in not realizing the full potential of the price. Now, you might have seen in see the volatility. When we say on a close to close basis may not exist, but on a high to low range it may exist. For example, almost on every day you will get the 220 rupees high to low. So today what happened? 17,375. 17,375. What is the low? 17,050 or so. So you got 325 rupees, which is much more than the normal volatility that you should have got. So in this case, if you have been able to move your option price when it moved up to 17,375, if you had moved your option basically to 17,375 at that point of time, then in that case, there is a chance that when the market fell down terribly, then you would have realized the full potential. So even if it is 17 to close basis, not on every day you will get the high V matching. And mostly on a close to close basis, the high V matching the 220 points, in this case of 18-20%, may not exist in all months concerned. Okay, at least on an average, we should get, suppose if you're talking about 220 points, so if you're holding it for 20 trading sessions, so in the 20 trading sessions that we should have a movement which is closer to 4,400 points of swing should have been there on a close to close basis. Now on a close to close, that is, see, there is a good chance that in this particular case itself, in the last few days, we have got 1,200, 1,300 points of swing. So let us say on a close to close basis, let us say if we count in the last this month from 4th April, if it has happened, this is 18,053, right? So here 1, 2, 3, so you 18,000, so something like 400 points. 17,400, here is some 200 points, 600, and here so from this place to this place, that is 17,784. 784, so you got something like 800 points. So there we have got some 600 points, 1,400 points. So here we had a movement from 16,958 to 17,390, another 400 points. So all these things were 1,800 points. So here all these things would have still only got you something like a 3,000, 3,500 points. So 4,400 points to realize, maybe we have got another 3-4 days. So getting very closer to the 4,400 points may not be that easy if you bought a 20% volatility. So in that particular case, to the extent that the shortfall in the holes is there, you will lose. So that means mostly you will have a 20% chance, 20% less than what the option price is what probably you will realize it by even rolling over the option, So that is one point we have to look at it, because the loss in terms of delta will always be there. Okay, so that is always to be factored. That is equivalent to what a cash market holding will be. So that will be done. But at the same time, there's another chance that whatever that you lose, that extra amount will come from the volatility not matching the expectation. So to that extent, there will be an additional loss. But in some months, you may get something more. So over a period of time, we expect it to get evened out. So what is most cruel aspect of the option is, that is the understanding the delta alone is not sufficient. Understanding the volatility, understanding the time decay is very, very crucial. So all these three option parameters, the most important thing that please note, that is if you are buying, now what is the volatility at which you are buying? Now we told you that 17,100, 17,130 for 26th May. So 26th May, how many days here today? Today is April is 30th only. So 1 plus 26, 27 days is there. So we'll go to the option price now. So underlying price is 17,130. Okay, exercise price is 17,100. So days to expiration 27. Now since we are putting the futures, we are not putting the dividend yield or the interest rates here. So let's do this calculation to know what is the volatility to get a price which is 360 rupees. 386, so we'll put it as 18%. So it is 18.5% right now. I think the price comes closer to 18.5%. Yeah, so the right now, if you see, there's a white background, so you may not be able to see very clearly. But what I'm trying to say is, the price at which it is traded now for a 17,100 call option, with the futures being at 17,130, the volatility that we are purchasing is 18.5%. So 18.5% has to come. That means 18.5% reflects 1 divided by 256 into 18.5. which is around 1.15% on a 17,200 thing. This approximately comes to 200 points. So every day we need something like a 200 points movement on a close to close basis. On a close to close, some days it can be more, some days it can be less. Okay, so what we need is a 200 points, approximate 200 points. It could be slightly 175, 180, because in the delta multipliers to make it some advantage of that. So you need a figure which is closer to 200 points on an everyday basis to get that. So the 200 basis points, whether we are going to get an everyday or on a cumulative thing on that particular month, is something which we are not assured of. But chances that we have to factor a fall which could be 20% lower than that, and look at our option price as 20% more expensive. So 360 means probably the ideal price could have been something like 300 rupees in the present volatility for us to make money. So that is where probably we should be thinking that we have to be satisfied once we at least have that direction clear. We have the movement which happens to the extent of the option premium, and once the price is much more than the option premium, then in that case we should look towards withdrawing ourselves for some profit, depending on to what extent, because you can't keep quite always. To what extent it can go maximum, that is where you have to understand. The volatility is very important to understand. Now, in this particular month, let us say I told you last time itself, when we are talking about a 350 rupees approximately as the option price, then the movement is expected from high to low is going to be around 1000 points. So 1000 points is the likely figure. Now let me say, now at this point of time, see here, 17,400. So we said that 17,400 is a very important resistance level. So 1, 2, 3, 4, 5, 6, 7 days have gone. So let us say you are now purchasing for the month end. Okay. Now assuming the price is going to fall straight away from here. So by end of somewhere around by 21st of May, or very closer to our option expiry, the price high to low could be 16.4 to 17.4. That is what the option price tells us. Okay, it could be slightly more, but it could be around 16.3, 16.4 on the lower side and 17.4 on the upside. So this is what the option price tells us. Now when it happens that way, okay, let us say you are holding a put option. You have bought it at 17,000 for 200 rupees. You have bought a 17,000 for 200. So when do we know we should take the profit? Assuming you are at a maximum point of the range, you should take the profit. You should not wait. So that is also very crucial in doing option. So when you are doing an option buying, you should know probably at suppose if you are holding the option, what is the maximum price thing that you should keep this particular option open, and when you should close it. Now if the price comes to 16,400 this month, or even 16,600, because 20%, let me give it a little lower, even if it comes to 16,600, say let us say 16,600, if you have bought a 17,000 option, then in that case put option for 200 rupees, you should be in a position to get out of that. You should be in a position to get out of that, because normally this option price, let us say you are buying because a lot of the traders think that it's safe to buy a straddle. We will come to that later on. So if you buy a 700 rupees straddle movement, okay, the chances that is going to give you only another 300 rupees profit at the maximum point, and if you miss it, then it's going to make a loss. So immediately the next question that will bounce, then can we sell the option? Okay, probably the answer could be yes, but sometimes what happens is there are huge risks, like the Ukraine war, type of something unknown factor comes. In that particular month alone, let us say there is a 2000 points fall, then we are finished, because as a trader, our psychology is that we can't do it consistently, because let us say that month we have lost some 1000 rupees. Next month you do, probably you may win. So the consistency is most important, but whether we can do it consistently, I think that's going to be a major problem, because we will definitely get befuddled by the stock movement. We will also get totally paralyzed by the developments, and probably will feel that no, this is how it could hurt you in future also. So you will be afraid of doing this consistency. That situation will come. So that is the reason why small players are fearful of going for selling of option, and that is going to be a very, very risky thing. The only thing that you can do is you can do your spread probably, and probably you think that 1000 points fall may not come that much. So what you should do is that if you are at 17,000, okay, you should do a 17,000, 17,800, 18,000 option. Similarly, you should do a 17,000 and 16,000 put option. And probably ensure that the benefit that you get of the 700 or 600 rupees benefit, normally even if there is an high to low, hopefully that it will not the close of the month, it will not be to that extent of 1000 points. It may be 600 700 points or so. That is what we have seen in the last 5-6 months or 7 months. So on a close to close basis, getting a price which is more than 650 or 700 rupees is not going to be that easy. It's not going to be that easy to get that. Okay, so that means we just double the option price. So getting that price is not going to be that easy. So that means what you should do is that we should look at something like now we are getting 17,200 option. We should be looking something like a 17,200 and expecting a 16,400 on this side. Then in that case we should go for 17,200 put option sell, and a 16,400 put option buying. Okay, similarly 17,200 to 18,000, 17,200 sell and 18,000 call option. Probably that can work. So let us see. So now let's say the price. So 17,200 is 366. 16,400 is 108. So you get something like 250 points. And here also you get 304 and 304 250. So you're getting something like a 500 points. So 500 points means the break even is going to be 16,700 here and 17,700 there on that side. So even if there is going to be a fall, since we don't expect much below 16.4, what we can probably do is that just do some one or two points of rollovers. Okay, if it comes by 200-300 points down on the side, we can just do a rollover and leave it. So 200 to 300 points of rollover, I think probably we can do it and leave it there. So if the price starts falling, then in that case you just keep selling the option to this extent of 200-300 points down, and there also you do a 200 to 300 points on the call option side. So that we will illustrate in future. So by doing this, probably you will be slightly mitigating your risk without that means if the fall takes up to 16.9, so you can do up to 16.9 to whatever that we have done right now, 700 800 points. So you will have something like 16.9 to 16.1. Okay, 16.9 to 16.1 is where, and probably there also you would have moved from 16.9 to 17.3 or 17.7 or so. So that probably could be a little safer for us to do that. So those type of structures can be considered instead of going for naked selling of option. So the basic thing that today that we will continue this discussion again. So with the help of understanding the maximum possible range and how to neutralize some of this, that what we saw, that is the time decay. As I told you, if the volatility does not come up to the expectation, then in that case we are going to lose on the value of the gain in the premium, which should have matched the delta. So that is one thing we should understand. Second thing is that if the market continues to be flat, the entire amount of decay will go. So what is the best alternative to do to some extent in order to control the volatility, to reduce, mitigate the risk, okay, of that? Then we have to think about no option structures. So one of the option structures is a spread option. Second option structure is a butterfly, because you are buying and selling options there. So one of that particular structures should be a butterfly. That is what we illustrated. That clearly, if you buy last time illustrated, you buy 17,000. Now we don't expect much below 16,400. Okay, we said that no, you can buy a 17,000. We can now buy a 17,000, 16,700 and 16,400. So let us say 17,000 option is 290, 16,700 is 192. So 190 also, that is into 2 is going to be 380, and 17,000 is 290. So you get some 100 rupees there. Okay, 90 to 100 rupees. And so 16,400 is 121. So you don't need to pay much price. So let us say 17,000 option is 290. So 17,000 is 290. 16,700 okay is 190. So 190 into 2, 380. So this is 290. So 90 rupees. And 16,400 is something like 121. So you will end up only paying something like 30 rupees or so, right? So 30 rupees or so. If you want, you can move down slightly, because you don't expect much below 16,400. If you want, we can just ensure that we move down, let us say so 16,300 is 102. 16,300 is 102. So that is a very good option, 102. So that means we don't need to pay anything. We don't need to pay anything. We are taking the risk between 16,400 and 16,300 to the extent of 100 rupees. I think it's a wise decision, because the chances that it's going to be much below 16,300 is going to be limited. Okay, because of the 1,000 points movement which I told you. So I think whenever there is a bounce back and it closes below 17,000, or even around 17,000, 17,100, even the last day, you'll be able to realize that 12 rupees or so, right? So I think looks to be definitely a much better option in this. So I think we should consider this particular option of butterfly. That ability to construct that butterfly comes from understanding to what extent the volatility can be. Okay, so now when we say 350 rupees in the option, getting it even two times of that is going to be difficult. So that means when you're talking in this month, we are talking about 17,100. Chances that it could be much below 16,700, 16,400 is going to be very, very limited chance. So that is where you should construct. So we will try to make an understanding of all these things and look at some of the options in other shares also, like Reliance. To what extent we could go for Reliance? What is it that we can do as far as the this one, that is the butterfly option is concerned. So we will look at some of these things, and then with that understanding, we'll proceed a little bit in future. Okay. So now it's a time for you to ask any questions. If you are, please ask. Thank you. So thanks for your participation. We'll elaborate on this again with the structures next week. Thank you very much. Bye-bye.